Reciprocal tariffs just rocked global trade. The market had its worst week in months, and everyone's asking, are we at the bottom or is there more pain to come? Let's get into it. Welcome back to Stonkcast, the market show for the average Joe. Whether you're a diamond-handed degenerate looking for the next 500% play or a more conservative swing trader or investor, we've got you covered. We tackle the latest market news, give our 2 cents, and maybe, just maybe, help you make some money along the way. I'm your host, as always, Brandon Shar. Happy Sunday, everybody. And yeah, let's get right into it. Last week was, how do I put this? It was a bloodbath. Let's just call a spade a spade. President Trump decided to drop his tariffs. And look, we all knew it was coming. This is something that he ran on from the get-go. Even heading into the election in November, this was something he talked about a lot. Tariff, it's a beautiful word. We're all familiar, right? So this was no surprise. I think what the surprise was how it was actually calculated. So let's get right into it. Let's do a tariff breakdown. So last Wednesday, Trump decided to, finally release the tariffs, something the market's been paying attention to and greatly anticipating. So April 2nd was the day everyone had marked on their calendar. We got tariffs that came out at 4 p.m. And initially, right around like 4:05, 4:10 p.m., right after the market closed, the futures markets actually went up. And I think it was based off of some speculation. I think there was a news report from, I believe, Wall Street Journal, or maybe somebody else had it, that basically said that the tariffs were going to be 10% across the board. Well, as it turns out, that was not the case. 10% was the bare minimum that Trump and his team had decided on. And majority of the tariffs were actually, in fact, much higher, which we ended up finding out not that long afterward from Trump himself with his giant board. So basically, according to the BBC, right, the calculations that were done on these tariffs were a little bit different than what the market expected, right? So I don't know about you, but when I hear that we're going to get tariffs put on to these other countries, these reciprocal tariffs, I'm thinking they're going to be based off of the actual tariffs that are put in place on us as a country. And that's not how these were calculated at all. It was actually based on a deficit, right? So for those on YouTube right now, going to share my screen here. Let's take a look at this report from the BBC. When Trump presented a giant cardboard chart detailing the tariffs in the White House Rose Garden, it was initially assumed that charges were based on a combination of existing tariffs and other trade barriers, like regulations. But in fact, the White House published what might look like a complicated mathematical formula. Looks pretty complicated to me. But as the BBC breaks it down here, if you unpick the formula above, it boils down to simple math. Take the trade deficit for the U.S. in goods with a particular country, divide that by the total good imports from that country, and then divide that number by 2. So a trade deficit occurs when a country buys, imports, more physical products from other countries than it sells, also known as exports. And so basically, when you take a look at the chart, for example, right, as this article lays out here, we're just going to take the European Union equation here as an example. The U.S. buys, more goods. Well, first of all, let's go China, right? So as you can see from the article here, the U.S. buys more goods from China than it sells to them. There's a goods deficit of 295 billion. The total amount of goods it buys from China is 440 billion. So basically dividing 295 by 440 gets you to 67%, and you divide that by 2 and a round up. Therefore, the tariff imposed on China is 34%. So initially, when I saw this big board on Wednesday after the market closed, I was thinking, holy crap, did not know that China tariffs the U.S. at 67%. But technically speaking, they do not. That's not how these calculations by Trump and his team were put together. And so here's another example with the European Union, right? So the trade deficit with goods with EU, right? 235.6 billion divided by imports from the EU, 605.8 billion equals 0.388 or 39%. This is what the US says EU charges. Then this is then divided by 2, which gives us 20%. And so that's the reciprocal tariff that is currently being put in place by Trump and the team here in the United States on the EU. So, needless to say, right, it wasn't exactly what the market anticipated. Anytime the market gets a surprise, as we've talked about on the show many, many times, it's not good, right? The market likes to be able to anticipate things. When the market cannot anticipate things, it creates a lot of headwind for investors, and we get a lot of volatility, which we'll get into here in a moment. We definitely got a volatility spike off this. A lot of people are trying to now kind of catch up based off of this new information that dropped mid last week. And also, not to mention the fact that now we need to wait on these other countries to see how they're going to respond, if they're going to come out with their own reciprocal tariffs on top of what Trump and his team have imposed. And are we going to get a full-fledged trade war? That's basically the question now that a lot of people are asking, and rightfully so, right? Because this is not what anyone anticipated. It was way more aggressive than anyone thought. So that's what we got as far as the tariff breakdown. Now, just as far as some updates on the tariff situation, if we take a look, according to CNBC, Trump tariff fallout. So Navarro downplays sell-off while Musk slams his qualifications. Tech and finance chiefs reportedly head to Mar-a-Lago. So a group of tech and finance leaders is headed to President Donald Trump's Mar-a-Lago resort to talk common sense about his sweeping tariffs. Several sources told tech journalist Kara Swisher. Elon Musk took aim at Trump trade advisor Peter Navarro, disparaging his qualifications in a post on X. Quote, a PhD in econ from Harvard is a bad thing, not a good thing, unquote. So Elon Musk is getting a bit of a heated exchange with Navarro. So you can already see tensions are kind of rising here as a direct result, right, from these tariffs and who they're impacting. Elon, of course, being the head of Tesla, obviously one of these companies is going to be greatly impacted by these tariffs. Navarro, meanwhile, downplayed the sharp market sell-off triggered by Trump's aggressive tariff rollout, vowing the Dow, get this, the Dow will hit 50,000 during the president's term. Somebody mark that down and cross-check that in 4 years' time, because I'd be really curious to see if that ends up happening. Seems a bit optimistic given where we're at now, but you never know. Trump responded to China in a post on Truth Social, quote, saying, hit much harder than the USA, not even close, unquote, in terms of trade. So Trump, of course, is feeling very confident in how this is impacting the US relative to China. Look, he's saying it's affecting China way more than it is us. That's at least what he's saying. China said, quote, the market has spoken, unquote, following the U.S. imposition of sweeping new tariffs, and called for the White House to defuse the escalating trade war. And then lastly here, U.S. markets dropped Friday after China announced retaliatory tariffs of 34% on all goods from America. So there's just another example of how, these tariffs that were given to us last week by Trump and his team were not exactly the tariffs that were being imposed, because China announced retaliatory tariffs 34% on all goods from America. Yet, according to that big board we saw Wednesday afternoon, China tariffs are actually closer to 67%. So you can see, based off of the equation and how these things were actually calculated, it's not quite the same. So, needless to say, there's a lot of chaos in the market right now due to these tariffs. And, you know, basically the week ahead is going to be really, really interesting as far as how it affects the market, right? So, since Wednesday afternoon, we saw that initial pump up for the first 5-10 minutes when everyone in the market got faked out, thinking that these tariffs were going to be sweeping 10% across the board. As it turned out, as we all know now, it was way more devastating than that. And the markets reacted accordingly, sweeping sell off on the markets. And really, the past 2 days have been nothing but selling. If we look at Thursday and Friday combined, it's been brutal. Just to take into account the VIX, right? The VIX is currently pushing 45. Now, just as a recap, right? The VIX is the fear gauge. Excuse me, the fear gauge on the market. Anytime the VIX is above 20, it's bad, right? There's a lot of uncertainty. 45 is pretty insane. So basically, that's where we're at right now on the VIX. Want to take a quick look here and just kind of break down what we're seeing on some of the key components of the market. Let's take a look at the overall index. But first, right, usually what we take a look at here on Startcast would be SPY, right, which is a ETF that tracks the overall market. But lately, what I've been paying more attention to, shout out to Tailored Trades with JP and Kevin for this information. But recently, I've been paying more attention to the actual index itself, which would be SPX. Refers to the S&P 500 index. So it's a benchmark of 500 US publicly traded companies. So how is this different from SPY? So SPY is an ETF that aims to replicate the performance of the S&P 500 index. But in light of some of the volatility we've been seeing lately, I would rather take a look at the actual index itself versus the ETF. So with SPX, the actual benchmark, this isn't something you can trade. The purpose of SPY is that you can trade an ETF that is tracking, the S&P 500 benchmark itself. So there's no volume on SPX. You can trade options on it, but you can't buy shares of it. It's literally the benchmark itself. So if we just take a moment here for those on YouTube, go ahead and pull up Thinkorswim, and we will take a look here at the SPX. This is the 1-year chart for it. Got a few different levels laid out here. Again, shout out to Tailored Trades and JP in particular for some of these levels that he laid out. Let's go ahead, though, and take a look at a longer dated chart. Let's go 10 years on a weekly chart and just kind of put things in context, right? The last major sell-off that we had was, of course, the COVID correction that we had back in early 2020. If you take a look, that is right in here. And from top to bottom for that correction was just about 34-35%, right? If we take a look at where we're at right now from the highs that we had back in February to basically Friday, as we continue to see this intensified selling pressure from tariffs, we're currently at 17%. So we're already about halfway to that COVID correction, which is just insane. I mean, the market as a whole this past week, I think, gave back something like $2, $3, $4 trillion in a matter of a couple days. It's been insane. So that's a quick look here at SPX in particular. It's been pretty devastating on the market. There's a lot of uncertainty. As you can tell here, we've already creeped below the August lows. We got the May low and the April low sitting here at just above 50.11. You got 49.53 for the April low. And we're currently sitting just above 5,000 at 50.74.08. So this week is going to be really telling to see whether or not we're going to, get a base here, which we'll talk about later, or if the selling pressure is just simply going to continue, right? So that's a look at SPX. Let's pull up the Qs, the NASDAQ here, the tech heavy NASDAQ. And as you can tell, this thing also has just been getting freaking demolished. We continue to sell up pretty hard on this Thursday, Friday, similar to the SPX, of course. No surprise there. We're continuing to get a ton of selling pressure on the Qs. And as you can tell, the 52-week low on this one is 413.07. And we're creeping down to it. We're currently at 422.67 on the Qs as well. Let's take a look here at IWM. Also getting wrecked. But on Friday, it did put in what might be considered a bit of a reversal there if you take a look at that daily candle. So something to keep an eye on. And then if we take a look at the VIX, again, the VIX is it's insane. Look at this candle on Friday for the VIX. We went from 30 up to 45. It's getting pretty ridiculous. And it just continues to creep up. So this week, is it going to stabilize up at these regions? Are we going to get a pullback? These are all things that I'll be paying attention to. Obviously, we had the spike up to 65 back over the summer, and hopefully we don't touch that again. But as of right now, the VIX looks insane. Let's pull up Apple. Let's take a look at Apple. One of the Magnificent Seven, obviously getting crushed. And when we just think about tariff impact, right? For a company like Apple, I believe something like 80, 85, maybe even 90% of the products that Apple produces are actually overseas. So yes, of course, Apple's going to be impacted by this. And the ironic thing about this is the fact that Tim Cook and, Apple were just praised by Trump not that long ago for deciding to move back some of the production to the States, something like $500 billion being invested into the US, right? And then these tariffs come out and, it doesn't really seem to help them out all that much. So Apple's getting smoked right now, just like everything is. Everything in the market's getting smoked. And then let's take a look at Tesla. Tesla as well. I mean, we had the 200-day moving average at 288. We kind of tapped it. We're selling off now. And we're continuing downward, it looks like. I don't really see any support for this at all until 187.20. Shout out to Taylor Trades, JP and Kevin for that level. Supposedly there's quite a bit of institutional buying interest right at that level. So it doesn't really seem, if that is true, right, it doesn't really seem like there's a lot holding it up until this point down here. So I wouldn't be surprised to see this thing continue to sell off. So as far as where we stand right now with the markets, yes, there's been a ton of selling pressure. I mean, we're seeing percentages on the indices that we're not used to seeing. You got SPY, you got the Qs, and this like 4 or 5% to the downside range on a daily basis. This is something that the market isn't accustomed to seeing on a daily basis, and this is what we've seen past couple days, Thursday and Friday in particular. If we try to look at this thing logically, right, let's try to look at some of the selling pressure in light of what we know are typically referred to as correction territory, as bear market territory, right? With traditionally what we're looking at with a correction, that's going to be anything that's 10%, right? 10%. So in the stock market, correction territory generally refers to a period where a stock index or a market falls 10% or more from its recent highs, but less than 20%. So that's the key there, right? So if we're just looking at correction territory for the overall market, it's got to be less than 20%, but more than 10%. Right now, we're sitting at 17%. Now, once we cross over and drop below 20% as far as a loss from those recent highs, that's where we're looking at a bear market. Right now, the Qs, the NASDAQ, right, is in a bear market. It's over it's over 20%. Same with IWM. We look at SPX, right? The overall market, the 500 largest companies in the market. From those highs that we had back in February, we're currently sitting right around 17%, as I said earlier. So we're not quite in that bear market territory, but boy, oh boy, are we not far off. Only about 3% more, and we'll be in that 20% bear market territory. So technically, on the SPX right now, we are still in correction territory. But this week ahead, look, um, it's going to be really telling, especially with the economic data that we have coming out, which we'll jump into here in a second. It's going to be really telling between that, between whatever else comes out relative to tariffs, right? Are these other countries going to impose reciprocal tariffs after what Trump already introduced last week? Are they going to back down? Are they not? I've heard rumors that Vietnam, which Trump imposed 100%, or excuse me, 50% tariff on them. I heard that Vietnam is going to be dropping their tariffs on the U.S., which if they did that would definitely impact some of the U.S. companies that are making their products over there in Vietnam. So there's a lot that can happen. There's a lot of uncertainty around these other countries and what they're going to do or not going to do, right? And we've already seen countries like China that have been threatening the US, saying, hey, look, you better drop this or we're going to lay our own hammer down. And that's obviously going to scare investors as well. So economic data for the week ahead, right? So we have some big data that is coming out this week. Let's take a look here. According to Bloomberg, next week, right? So we have consumer credit coming out on Monday for February. We also have a 3-year note auction coming out on Tuesday. You got the FOMC member daily speaking. And as far as some of the more volatile, important economic news that is coming out next week, at least according to Bloomberg, on Wednesday, we get crude oil inventories. And then we get a 10-year note auction coming out also on Wednesday, and also the FOMC meeting minutes. So those are some of the more important things that are coming out towards the beginning of the week. Now, the 10-year note auction, why is that important? It's important because due to this market correction that we have going on right now, you're going to see an uptick in people buying bonds. You got people fleeing equities. Generally speaking, when you have a bear market, when you have a lot of uncertainty in the equity markets, and there's not a lot of gain going on, a lot of investors will flee equities and go to the bond market, right? And we can see that clearly represented here by this view of the bonds right now. You got the 20-year, the 30-year, the 2-year, and the 10-year on here. But the most important thing to pay attention to, this is the bond yields, right? So when yields go down, it means that bond prices are going up. So basically, if you have yields going down, that's not a great thing for equities. And right now, as you can tell, the yields, right, on all of these bonds are currently going down. So it's not a great situation for the equity market. Looking at Thursday, as far as economic data, boy, oh boy, do we got a doozy. We get CPI data coming out at 8:30 a.m. That's going to be huge for the market. If we take a look at CPI year over year, last month was 2.8%. What is forecasted to come out this week is 2.6%. If that number comes in hotter than 2.6%, that is not going to be good for any hopes of a rebound, a retracement, a bottom on the selling that we're seeing in the markets. It's just going to intensify things, right? Because the Fed is not going to be in a position to feel like they can actually cut rates until they see that inflation number coming down, right? And in alignment with that, we also have initial jobless claims coming out. So we had 219,000 last month. The forecast is 223,000 initial jobless claims. So another thing here, if initial jobless claims come in really, really good, right? Let's say they're lower than 223,000. That's going to be a situation where Jerome Powell and the Fed are not going to feel inclined to feel like they need to cut rates because they're not seeing an uptick in jobless claims. The forecast is higher than previous. We'll see how that number comes in. You got some more Fed speakers coming out this week. And then on Friday, we got Michigan consumer sentiment for April. So got a few different things here, but the most important thing I would say, and PPI, of course. So really CPI, PPI, you got a couple bond auctions happening, you got a couple Fed speakers. We're basically hitting a scenario where we're going to be very dependent upon economic data. That's basically what we're looking at for this week ahead. So it's going to be very important to keep your eye on that. Keep your eye on what these numbers come in as and how the market reacts to it, right? The market hates uncertainty, and that's what we naturally have right now, given the environment that we're in with tariffs. And so any poor economic data that comes out this week is just going to add fuel to the fire of this already uncertain environment that we're in. Now, as far as what we could be looking at for the week ahead, as far as, watching for a bottom, anything like that, as I pointed out earlier, for me personally, I'm keeping an eye on SPX, the overall index, for the market and some of the lows of, previous months. So for example, the May low, 50.11. We're currently at 50.74. I'm also watching the April low, 49.53. So we're creeping up to that territory. Also, keep in mind that we are creeping up to bear market territory. Again, we're only 3% off from that. The SPX is currently down from its recent high, 17%. So be very, very cautious heading into this week with the VIX as elevated as it is, right? You're going to see a lot of IV percentiles on these option chains in the markets in the 100% percentile, meaning 100% of the time, the IV, the implied volatility for these option chains are lower in the past 52 weeks. And that's because of the spike in volatility that we've seen. So if you are a buyer of premium this week, you're going to be paying a pretty penny. So just be mindful of that. Statistically, it might be better to be a seller of premium in this environment. But as for me, I am not really looking to get into any scenarios that are bullish, at least in the short term. I'm following the trend. Wednesday last week, I swung some calls. Very stupid idea, swinging calls into a very volatile conference that Trump had with tariffs. That was a bad idea, and got my face ripped off. So come Thursday, when the market opened, I took it on the chin. I sold those calls. I read the market. It was going down. I followed the trend, and I was able to make that back and then some come Friday. So as for this next week, I will be looking to continue to follow the trend. Yes, we're coming up to some long-term support on SPX. As I just mentioned, we have that May low, that April low, definitely areas to pay attention to. But look, you have to keep your eyes on the news this week. You also have to keep your eyes on the economic reports coming out because they're all going to tie in together. So it's going to be very important this week to be on your toes. Make sure you have good risk management, and keep in mind, as we've mentioned on this show many, many times, that when it comes to bear markets, when it comes to these kind of environments where you have volatile moves to the downside, you're going to get upswings that are equally volatile. So come Monday, could we get a dead cat bounce of sorts and the market rips up, 20, 30 points on SPY? Sure, that could happen. You could also have an environment where we saw Thursday and Friday, and the futures open up tonight, and we're already down another, 4 or 5%. So that's another thing, right? Futures tonight. When the futures markets open, definitely pay attention to that. See what's happening overseas, Asia, Europe, how the world is reacting, how the U.S. futures markets are responding. That'll be an indication of what to expect for tomorrow morning, and really for the week ahead. So that's about it here for Stonkcast. That's about it. We will be back midweek, probably Wednesday or Thursday. Would love to get your take on the market. Please leave a comment like and subscribe. Where do you think we're headed this week ahead? What are some tickers that you're paying attention to make a quick buck? What are some things that you're looking to avoid? Yeah, we would love the support. As always, we are on iTunes, Spotify, Pocket Cast, wherever you listen to your podcast, you can find us. That's about it for now. So thanks for tuning in. Hope everyone has a great week. Stay vigilant. And as always, remember, plan the trade and trade the plan. Have a good day.